Hello and welcome back to our educational video series. Today, we'll take a look at why rising interest rates are usually bad news for the stock market. So, you might have heard that central banks are raising interest rates at a very sharp pace in order to slow down demand in the economy and ultimately bring inflation under control. This process usually hurts stock markets for various reasons. Let's start with something simple. When interest rates go up, that makes it harder for consumers and for businesses to borrow. They have to borrow at higher rates and they essentially pay more on their loans. That's problematic for the economy, since it makes it more difficult for businesses to expand and hire people. Ultimately, this process slows down demand, which hits corporate profits. So there's an economic argument for why higher interest rates are negative for stocks. But there's also another financial angle which has to do with alternatives to stocks. When interest rates are high, returns on government bonds are also high. Today, an investor can buy a one-year US government bond that delivers a 5% return risk-free. If someone can earn 5% in 1 year on a bond without any real investment risk, that makes it less likely they will take chances in stock markets, which are inherently riskier and more unstable. Think of it in terms of demand. The higher interest rates go, the more attractive it becomes to hold the bond, and the less attractive it becomes to hold stocks. Bonds essentially steal demand away from stocks as interest rates move higher and higher. And as we said earlier, equities also become less attractive from an earnings perspective as the economy slows. That's it for today. If you have a question, send us an email at this address and we'll try to answer it in future videos. Thanks for watching.